Hello and welcome to Opal Wealth Advisors 5 retirement risks that you can't afford to ignore in retirement. In this program, we are going to cover what every retiree should know about protecting their future retirement. If you're watching this webinar, you might be thinking, I've worked hard over my lifetime to build the wealth that I have today, and I want to make sure that I get the most out of the rest of my life. You want to enjoy your retirement years. And when you were younger, you may have counted the years from when you were born, but now what may be present for you are the number of the years that you might have left. You want to make the most of it. And your financial success is an important factor in that fulfillment. Some of the challenges and questions that you might be pondering include, how do you maximize your investment return and income while managing the risks and the impact of taxes? You might be thinking, when should you take Social Security? How do you prepare for costs of healthcare in retirement? How do you structure a cash flow plan so you know when the money is going to hit your account each month? How do you spend down and distribute your assets that you've worked so hard to accumulate over your lifetime? How do you make that shift from accumulation to decumulation? These are all great questions. And in this webinar, we will break down the 5 retirement risks that you can't afford to ignore. Before we get started, this presentation by Opal Wealth Advisors is intended for the general information purposes only. No portion of this presentation serves as the receipt of or a substitute for personalized investment advice from Opal Wealth Advisors or any other investment professional of your choosing. Please see additional important disclosure at the end of this presentation. A copy of Opal Wealth Advisors' current disclosure brochure discussing our advisory service and fees is available upon request or at opalwealthadvisors.com. Now let's get into the content. My name is Jesse Giordano. I am a certified financial planner and partner in Opal Wealth Advisors, a registered investment advisory firm that helps hopeful retirees like you achieve their most meaningful financial goals through our retirement income planning and financial planning process that we call the Opal Way. We are fiduciary financial planners. That means it's our jobs to listen to what you want to achieve, what's meaningful to you, and then help you build a strategy that's in your best interest to fulfill your goals. In other words, we're not compensated by selling you products like many other advisors are out there. So you can rest confident that the strategies that we will help you create will have your best interests at heart, and that we will have your back every step of the way so you can live the life that you have always dreamed of. Let's get into it. So what are the 5 core risks in retirement? Well, number 1, it's longevity, living longer than you expected and outlasting your savings. The second one that we're going to cover today is inflation. Basically, that's the rising costs, an erosion of your purchasing power over the rest of your lifetime. Then, of course, there's market volatility, the ups and downs. Then there's healthcare costs, unexpected expenses in retirement that can derail retirement. And then lastly, taxes. Let's get into each one of those. When it comes to retirement, you don't get a do-over. And what we mean by this is if you run out of money in retirement because you didn't prepare fully, it will be very difficult for you both physically and emotionally to go back to work 10 to 15 years later. If you live to age 65, it's reasonable to expect that you could spend 20 to 30 years or more in retirement. And if your retirement income plan does not address the possibility of living that long, then you can be taking on tremendous risk. This chart here shows the probability of both men and women living to 90 years old. Now, to you, that may seem unrealistic or improbable, but women in general have a 33% chance of living to 90 years old, whereas men have a 21% chance. However, for a married couple between a man and a woman, there is a 47% chance that at least one of them will live to 90 years old. That's almost 50%. That's a pretty good odds that you need to prepare for. So it's important to consider the most appropriate age to retire. Not too young and perhaps not too late, such that you can't enjoy retirement either. The message here is not that you shouldn't retire, but rather to make appropriate assumptions in your plans for how long you may live. Another issue compounding longevity risk is increasing prices over that time. And that brings us to risk number two, inflation. Inflation has been an economic phenomenon that we have all gotten used to over the last few years. And while recent inflation may be higher than normal, even inflation of 3% per year can have a dramatic impact on your retirement. This chart here shows that $50,000 of goods and services that you purchase today will cost $67,000 a year in 10 years from today. And those same goods and services in 20 years will cost $90,000. And in 30 years, those same goods and services, $121,000 per year, more than double. Retirement income plans that fail to project the increasing costs of retirement may inevitably fail by falsely concluding what costs will be each year, when a safe time to retire is, and how much one needs to meet their goals. It's often regarded that stocks are a great inflation hedge. That may be true, but owning too many stocks can introduce portfolio risk or market risk, or what's sometimes referred to as sequence of return risk. Take a look at this illustration. On this chart, you see two portfolios. Both of them start with $1 million. Both of them earn 6% per year on average. And the investor is taking out $60,000 per year to cover spending and expenses over the following 15 years. While both these portfolios have the same exact average return, Portfolio A runs out of money by year 11, while the other, Portfolio B, is unchanged or very close in value by year 15. How is that? How is that possible? How is that one portfolio can earn 6% on average, and the investors spend that 6% of the starting value, yet in one scenario the portfolio runs out of money, and in the other scenario, value is basically unchanged in the end? Well, the difference in these portfolios is that the rates of return happen in reverse order. While the average may be the same, there are different returns every single year. And what we did with Portfolio A and Portfolio B is we simply just reverse the order in which they occur. And if you know this, Portfolio A gets hit in the beginning, where Portfolio B, those bad returns happen in the end. So the conclusion that we ultimately draw from this is that when you're taking money out of your savings to spend in a down year, especially in the early years, selling to take a withdrawal and locking in those losses in those years can be detrimental to the future. So you don't have a crystal ball. You may not know what's coming in the next year or two from now. So how do you hedge this potential risk? Well, the first thing that you want to do is determine a safe withdrawal rate where withdrawals are not too much, such that you are forced to lock in losses when those down years happen. At the age of 65, statistically, a 4% withdrawal rate instead of 6% in this example is statistically much safer. Second thing to do is have a larger emergency fund or reserve portfolio set aside in retirement to spend from in down years if your portfolio was to decline. This reserve portfolio should have about 1 to 3 years of spending money. Whether it's 1 or 3 will depend ultimately on how much volatility is in your portfolio. The more volatile a portfolio is, the more money that you should have in reserve. Third thing you should do, consider stress testing your retirement income portfolio. Do you know how your portfolio would have done in the 2008 financial crisis? How did it do in 2022 when we saw a jump in interest rates? How would 2008 or 2022 impacted your ability to fulfill your life goals? The fourth thing you should do is minimize volatility through diversification and prioritize income generating investments. Just because the investment strategy you have had today or that has worked over the last 10 years doesn't mean it is appropriate for today's retirement needs. Consider what your mix of stocks, bonds, and alternative investments are, and what the appropriate allocation is for your future. Is that mix appropriate for your spending plans in retirement? Let's make sure they are a match to help you achieve your meaningful financial and life goals. One of the first exercises that we have new clients perform is to review their spending over the last few years so they can get an accurate picture of what they're spending their money on and what that number is per month on average. This can be eye-opening. In most cases, people are surprised by what the number is. So never just make a guess. Look at what the actual data, because from there, we can build a financial strategy and a spending plan that includes all of the meaning financial goals that you have that you want to add to this over your lifetime. One expense that investors fail to project is the future cost of healthcare. Here's a look at monthly healthcare spending by gender and by age group. The data is from 2016 and has increased meaningfully since then. And depending upon where you live, you can see dramatic swings. But nonetheless, this chart shows that costs increase substantially as you age. Women tend to spend more than men on healthcare as well, and older people spend more than younger people. A large part of these higher expenses later in life are for long-term care, but many people fail to realize that you have to pay for your Medicare premiums and Medigap policies once you become eligible when you turn 65. It's a government program, but it is not free. And lastly, if you're watching a video from a financial planning firm like Opal Wealth Advisors, I'd guess that you have worked hard at accumulating wealth over your lifetime and you have meaningful assets that you hope to withdraw from to support you and your family in retirement. One of the largest expenses that you may not have considered is taxes. And you may not realize that each investment you own may be treated differently for taxes. And thus, how you own them, like whether it's an IRA or a 401k or Roth, or just own them personally or joint with your spouse, the older in which you withdraw from them can have a dramatic impact in the amount of taxes you pay over your lifetime. So how you own them and where you own them and the order in which you withdraw from them can have a substantial impact in the taxes you pay. Different income sources have unique taxation. For example, Social Security, when you withdraw Social Security, that is considered income, and you will pay income taxes up to 85% of the amount that you receive. Do you have a pension? Well, you're going to pay ordinary income taxes on that as well. If you're a state employee, some states have a state income tax exemption on that, but not on the federal. And are you working in retirement? Well, you'll pay ordinary income tax rates there, but you'll also continue to pay into Medicare and Social Security without an additional benefit. In fact, it could cost you money by doing so. By working into retirement, you're raising your earnings and therefore raising your Medicare surcharges associated with that earnings. So it may cost you more for Medicare. And when you're paying into Social Security and withdrawing from Social Security, you don't get an increasing benefit, especially if you've already maxed out Social Security. What about rental income? Maybe you own that two-family home or a building. Well, there may be tax advantage because of depreciation, and those earnings that you receive, you might be paying income taxes on them. All depends on the structure. What about an inheritance? Well, depends on the source. If you get that outright from a personal account, you may receive that tax-free. But if you receive retirement account assets like an IRA or a traditional 401k, they are taxable if you take it out all at one time. It may be advantageous if you spread it over many years. You'll have to model out in your own specific situation. What about retirement plan distributions? Well, those depend, the taxation depends on the plan type, whether it's an IRA, a Roth retirement account, or if it's after-tax contributions. What about investment income and gains? Well, many different types of investments have varying different tax rates. So you need to consider how all of these are treated and what type of account that you have them in and the order in which you withdraw from them. Now, this might be a little shocking. Your IRA that you have or 401k may not be worth what you think it is. For example, A $500,000 traditional IRA or 401k that has it is not necessarily worth 500,000. Let me tell you why. If you are in the 22% marginal income tax bracket, it may only be worth $390,000 after you pay taxes. But what if you were in the 37% marginal income tax bracket? Well, after you pay that 37% taxes, you only have $315,000 left over. So while you may think that your IRA or 401k balance should be sufficient to carry you throughout retirement, consider that that IRA balance or 401k balance isn't what you think it is. What tax rate will you be paying in the future when you spend these retirement accounts? What if I said you may have a choice at what tax rate you pay? That's interesting. We have been trained our whole lifetime to defer taxes into the future. Take a tax deduction here, it takes a tax deduction there. That doesn't always eliminate the tax. All it may do is defer that tax liability into some future date down the line in our lifetime. Well, in retirement, you might want to start to shift that thinking. While deferring into the future may reduce your taxes today, someday that future will come and you'll find yourself dealing with a tax problem, maybe even a tax bomb. The bars in this chart that you see here represents taxable earnings each year of someone's retirement. And if you're like most people, you may be deferring taxable income into the future. And onto this chart, you might see the early years of retirement before someone takes Social Security, before they start taking retirement withdrawals, they might find themselves in a lower tax bracket. So when someone keeps deferring income recognition into the future, they might be pushing themselves into a higher and higher future tax bracket. And in some cases, many taxpayers will wind up paying higher tax rates in retirement than they did when they were working because of this constant deferral. So here's the solution, potentially. Instead of deferring for as long as possible, start paying those taxes in the early retirement by accelerating income. Start paying those taxes in lower tax years before you start taking Social Security and before you start taking distributions from your IRA. The result is to lower your average tax rates over your lifetime and lower total taxes paid over your lifetime. That could shift this chart from low income tax rates in the early years and high income tax rates in the later years to something like this. It's smoothed out. Instead of paying 37%, as this investor or retiree did in the previous chart, this retiree never paid more than 24%. So the question becomes, how can you accelerate income so you pay lower tax rates? There are lots of ways to do this, but it has to be modeled once you have developed a retirement income plan. You don't want to accelerate income. If you shouldn't be accelerating income, it's quite possibly you're already in a higher tax bracket, especially if you're still working. You don't want to do it in your earning years. But I'm going to give you one big tip. You can accelerate income to low tax years by converting your IRA or 401k into a Roth IRA or 401k in low tax years. Once you do that, you lock in the lower tax rate on the IRA, and all future growth becomes 100% tax-free. To learn that and more, you can contact me, Jesse Giordano, or your Opal financial advisor. So there you have it, the 5 key retirement risks: longevity, inflation, market volatility, healthcare, and taxes. I hope this has been valuable to you and that you've taken away some key ideas to talk with your advisor. If you have any questions or interests, please reach out to me or to learn more or to create your retirement income plan with hedges and protections to defend against these risks. My name is Jesse Giordano. I'm a certified financial planner and financial advisor, principal and partner at Opal Wealth Advisors. My phone number is 516-388-7975. You can also reach me by email at jesse.giordano@opalwealthadvisors.com. It's been great spending this time with you. Have a great day.